Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week. We're back to our live videos every Tuesday at noon after taking a holiday break and a slow start to the new year after I was recovering from catching the COVID virus and getting my energy back up again. But we're back at it, and thanks for joining us. Every week we cover off what's been going on in the market during that week, but more importantly, we take a look at what's coming up in the week ahead. And as always, everything that we say and cover in these videos is for information purposes only. Always do your own due diligence or give us a call. Go to mikeonmoney.com. You can reach us there. All our contact information is there. You can also see previous episodes or videos that we've done through our YouTube portal and also our podcast portal if you prefer listening to things while driving versus watching them. So as always, Louis, we always have to have our first update is just on where things stand with the COVID virus. Obviously, Omicron, which kind of hit Canada just at the beginning of December there, has been running rampant through the country, well around the world. You know, infection numbers are through the roof here in BC. Here in BC, they're not even really testing. As I mentioned, I had it over the holidays. My whole family had it over the holidays, and you can't even get into the testing centers unless you qualify, and the lineups are crazy. Most people have turned to the rapid test, you know, the antigen test, which are hard to get in the first place. If you can get them, and you got to, you know, most people have to buy them unless you can get them through your workplace. And, you know, the reliability of them aren't as good as the PCR, which is why, you know, there's a lot of controversy around them. But that's pretty much what's going on here in BC. Obviously, we've seen more shutdowns or closures across Canada, around the world, new travel restrictions being put into place for different countries, new testing requirements, depending on where you're going and where you're from. So all I can really say is stay safe out there. You know, do get your vaccinations. Mine was pretty mild, but I had got my booster in December, so I had my third shot, and that's pretty much the reports. You know, if you're fully vaccinated, it's been mostly pretty mild. I mean, obviously the hospitalization rates are increasing, but I think that's mostly just due to the number of people that are going through it these days. This wave is definitely different than the other ones, and in previous waves, as most of you, I'm sure, experienced, same as myself, I knew one or two people that you know kind of had the Delta variant, you know, and recovered. This Omicron seems to be almost everybody I know has either had it or someone in their family's had it, and they've had to quarantine due to exposures. It's just obviously way more infectious than previous strains. So that's pretty much it. Again, you know, travel is tough. Do make sure you check and double check your destination's testing requirements and also your return requirements. Obviously, Canada's got some strict rules, and make sure you're prepared for those. So with that, let's take a look what's going on in the markets today. We are looking for the Canadian housing start numbers for December. Early numbers are showing, you know, despite a large uptick in housing starts in 2021, demand has far outpaced it. At least purchase and demand. This is the big, you know, what's going on. Are we seeing a lot of people buying their first-time homes, or a lot of people getting into the housing market, or is it a lot of speculation? A lot of people speculated buying up those starts, those housing starts for investment purposes. Those numbers we haven't seen yet. And also we're looking for Goldman Sachs to report their fourth quarter results. We'll take a look at that. We've seen a few of the other financials firms in the US report already, and we'll cover those today as well. Stocks fell a bit this morning, largely led by tech stocks. Basically, the government bond yield rose to a 2-year high, signaling basically Investors are getting a little concerned about the interest rate hikes, especially growth style stocks, or the tech companies, and that's largely because they're more affected by interest rate hikes, because they tend to leverage their business more to continue that growth cycle that they happen to be in right now. Investors are expected a pretty tight labor market as inflation is prompting the Fed Reserve basically to carry out multiple rate hikes this year. I think you're going to see through all reporting today is the end of 2021 there was or through 2021 it was like when are the rate hikes going to happen? The experts were trying to hold off till 2023. There was back and forth last year as to whether they would make it that far. We originally were looking at later 2022. Pretty much the consensus now is it's going to be earlier in 2022. So there doesn't seem to be a lot of debate about it anymore. Just a general consensus that we are going to see rate hikes. The big question now is how many. And on the option exchange, the volatility index, or the VIX, has hit its highest level in months. So that's just showing people's, the general sentiment out there. People are concerned about the interest rate hikes and how that's going to affect their portfolios of their investments. Which, this is something we've been talking about all through 2021, the shift from growth to value. Our portfolios, we definitely by fourth quarter had shifted mostly to value in the portfolio, but we've been slowly shifting out of the growth into the value side of the market pretty much throughout 2021, as we knew we were going to get to this point, just didn't know when. On the other side of the market, crude oil, which if you watch December videos, we saw a bit of weakness as everyone's concerned about Omicron shutting things down and getting rid of demand. Well, through December and into January, demand still stayed pretty high. Supply has been a bit, iffy with different political and, the stresses around the world when it comes to potential wars or potential shutdowns of supplies in different areas. Has pretty much held the price of oil up, so it's been a pretty bull energy market out there. Hedge funds are standing by the US dollar despite a slump in the new year, so the US dollar had decreased a little bit into the market rallies of late December, early January. But despite that, we're seeing a lot of investment go into it, so we should see a stronger dollar in the next few weeks. As I mentioned, oil investors are pretty much looking beyond the Omicron as far as oil prices go. We did see, if you watch our last couple of videos in December, there was a lot of hedge fund managers, portfolio managers getting out, fearful of the oil price. And if your investment is purely into the commodity or the futures market around the oil price, we did see that drop down kind of into the low 70 range from about 80. But the stock prices, the producers, their prices didn't fluctuate too much, and in fact they've continued to rally up here in the last few weeks. So still been a strong market as far as that goes. Early holiday shopping pretty much hammered the U.S. retail sales. So one of the big indicators that we look at is, of course, how December retail sales are. How bullish are people about spending money out there? We didn't see a great December. We actually saw it being one of the biggest drops in retail sales numbers in December one of the biggest drops in 10 months for December. But we had seen some spikes leading into it, and that was, everyone was being warned, the supply chain constraints, they were going to be out of inventory, so do your shopping early. And we did see a lot of spikes in the sales numbers going into December, so I don't know if that's a huge concern when we look at those retail numbers, but definitely showed through in December. Not to mention everyone couldn't go anywhere in December anyway, so that might have another effect on things. Fed officials, are saying we're going to see those rate hikes as inflation continues to soar. Again, as I mentioned, the general consensus now is we're going to see those hikes. Biden is seeking to reshape the Fed. So Biden has appointed a new Fed Reserve Governor, Sarah Bloom Raskin, and as well as two new economists. Basically, they have the most diverse, democratically diverse, demographic diverse Fed in history, and as it's one of the most powerful central banks around the world, it'll be interesting to see what follows suit from that, but also if we see any kind of different views coming out of it. BlackRock's assets crossed the 10 trillion mark. All its revenues slightly missed on fee squeeze. So BlackRock, if you're not familiar, they're a big ETF portfolio manager out of the US. They've gone through the $10 trillion under assets. But with that size, they have seen a squeeze on their earnings. We also seen a earnings test for the growth stocks after a rocky start to the new year. So as mentioned, the growth side of the market, are having a tougher go in the start of 2022, and certainly the end of 2021 than they did the end of 2020 and the early 2021, where we've seen them pretty much rocking the returns and leading the way as far as rate of returns go coming out of the 2020 year. But pretty much for the fourth quarter, we've seen kind of a negative trend in growth stocks, and that has come straight through into the new year, even a little bit more harshly, I'd say. So if you do still have a lot of growth stocks in your portfolio, I was talking to someone the other day, it's not a bad thing. I mean, you probably still have some good profits in there. We're into a new tax year. It's a good time to start, taking some profits out of those companies. You're triggering a little bit of tax, yes, but doesn't mean you don't like them, right? It doesn't mean that you can't come back and revisit them. Just how long do you want your money potentially to devalue if we continue to see negativity around the growth stocks? But also, even if they're flat for 6 months, 8 months, how long do the interest rate hikes continue, or that inflation fear continue? Do you want your money to kind of not grow for the next 12 months? We tend to take a much more tactical and dynamic approach to the portfolio. Where we'll take some profits out, maybe take the position out completely, but doesn't mean we don't like it. Doesn't mean we can't come back and revisit that again in the future. Even if we pay a little bit higher for it down the road, the money might, we want to get the money working for us throughout 2022. So yes, we might pay slightly higher or less, hopefully, but even if we paid slightly higher for that stock, we might have had the money earning more dollars in the meantime. So it doesn't affect your returns. In fact, it enhances them. So do take that into consideration when you're looking at some of the names in your portfolios. So let's take a look at what's coming up this week. We've got Bank of America is reporting fourth quarter earnings on Wednesday. We're looking for a kind of profitable outlook, but really want to see what the revenue numbers are, whether they've been hit with higher costs, and how healthy the investment bank pipeline is. Netflix is also expected to post that. We're looking for a good number there, as their subscriber numbers seems to have steady growth over the holiday season, and they've come out with some pretty good new proprietary content, so content that they have developed through that season as well, which has been increasing the numbers quite a bit. So we're looking for Netflix, and also as I mentioned earlier, the Labor Department Thursday is expected to show weekly jobless claims to have fallen, and housing starts obviously likely to slip a little bit on the holiday season, but we'll seasonally adjust those numbers. Other news: J.P. Morgan shares fell as it put out a mixed outlook, and despite it beating its profit expectations, the outlook, JP Morgan is pretty bearish for this year. So their stock took a hit. Citigroup profits dropped on higher expenses. So despite having a strong quarter with revenue, higher cost, basically driven by the fact that they exited the retail business in Asia, which was a source of extra revenue for them. So as they got rid of that division, it kind of hit the bottom line. Wells Fargo, on the other hand, beat profits estimates and seen a good uptick in the loan demand. people taking advantage of the low interest rates before we start to see those going up. We've already seen some of the mortgage rates increasing, but until we see the feds raise the rates, we won't see the full impact of that. Facebook and Google CEOs, this is the ongoing antitrust suits. We've talked about it through most of 2021. Definitely going to see it going into 2022. There's so many of them out there, different states. This is basically just new information that Facebook and Google execs knew about a deal to basically carve up the advertising market and control the online advertising revenues from smaller outfits. So the antitrust suit claim. As I mentioned, Netflix is looking to report with some pretty good numbers. Now, if you do have Netflix, of course, you're aware that they just increased the subscription price by $1 to $2 per month, depending on which service you subscribe to, both Canada and the US. So that's going to, add to their profits, but also add to their budgets for creating, more streaming content for the platform. On the dollar front, as I mentioned, the U.S. dollar, had slipped in late end of December and into the new year, but it's holding pretty steady where it is, basically on the imminent expectations of the U.S. Raising rates. Cryptocurrencies also showed some weakness, as they show, they're basically demonstrating that they also are sensitive to monetary policy, and as a risk asset tied to those which they weren't supposed to be, but they're basically trading lower if you trade into crypto. As I mentioned, the bond yield, the 10-year note, has ticked to an all-time high, or at least a 2-year level high of 1.83%. So that was kind of, if you remember, early 2021 when we were watching it, watching inflation and we're watching what's going to happen with interest rates. We had basically said once we get above the 1.8 to 1.85 on the 10-year note, that's when we're going to see the Fed basically be handcuffed to have to raise rates, and we're there. So no big surprise that there's consensus that we're going to see a rate hike. The 2-year government bond also rose to just over 1%. Again, its highest level since February 2020. On the commodity front, as I mentioned, oil has had a good rally, actually hitting the high of 88. I think I saw it this morning, trading in the 85 range. So still holding really strong in the mid 80s. Again, we're seeing that energy crunch happen as a lot of production was shut down. And there's been this, of course, a shift in focus to renewables, which we've talked about is going to take some time. And in the meantime, demand for oil continues to rise. So even with Omicron going on, as I mentioned, we're not really seeing a massive drop off in demand. And as supply continues to be under threat with different things going on around the world, we're going to probably see a strong oil price. Copper has weakened a little bit after a 2-month high. It had climbed. That's just basically built up inventories. So copper has been pretty strong for a couple of years now as far as pricing goes. And when you have strong pricing in any commodity, people go out and find a bunch more, right? They go out and dig it all up, and then all of a sudden you have extra supply versus demand. So a little bit of weakness is that supply side of things has increased. But if you're in copper, I would still say it's a hold. I wouldn't be overly concerned just yet. Gold continues to struggle a little bit. Was a little bit down this morning in early European trading at about 1833 an ounce. Gold's that one that didn't really perform the way market expected it to in 2021. Basically, we had strong inflation. Gold is usually a good inflation hedge. It obviously held its own through 2021, around the 1800 ounce level. Went slightly below that to 1750 for a while, but back up again. But not really the rally you'd expected in an inflationary period. So we'll continue to watch to see how it does with higher interest rates as the Fed starts to move those, and see if it starts to react as it normally would. If it does, we would expect for it to have a bit of a breakout because it has held back I think, some of its returns in the last year. So with that, if you have any questions, do go to mikeonmoney.com. You can send in your questions or just give us a call. We're starting a new year, so we're looking for new topics that you want us to have us cover. We're going to do some one-off. We're going to do a one-off on what the metaverse is and how to invest into it. And no, we're not talking about Facebook's parent company, Meta. The metaverse is actually well beyond just what they're doing. Obviously, it's a focus of theirs. We're going to talk about that. We're going to talk about renewable energy, what renewable energy is when we say that, what types are out there, what types might be a focus of the future, and where those opportunities lie as well. So we're going to do a video on that. But any other topics that you want us to cover, any other features you want us to build into these, new year, we're wide open to new ideas, and we're looking forward to hopefully seeing you all in person, maybe so at some point in 2022. But with that, thanks for joining us, and we'll talk again soon. Talk to you next week. Bye-bye.